Good afternoon, everyone, and welcome to the July 2023 edition of Epic Insight. This is Joe Corona. I'm the Director of Sales and Strategic Partnerships at Epic Retirement Plan Services, and I will be your host for today's call. As the healthcare and retirement industry continue to evolve, the health savings account has become an essential tool as a part of overall financial planning. Understanding the advantages an HSA can bring to your clients is an essential part of building a comprehensive financial wellness solution. With that, we are very excited to have joining us our very own Paul Oakford. Paul is the Senior Manager of HSA Services at Epic Retirement Plan Services. In this role, Paul leads the team in all aspects of health savings account, including program development, client relations, administration, web experience, and employer and employee HSA education. He also works with advisors, banks, trust companies, health brokers, and other financial institutions to educate them on the benefits of HSAs and consult them on how HSAs might fit within their practices and add value to their clients. Paul has been working in the employee benefits industry for over 19 years. Since 2004, he has specialized in the area of HSAs and consumer-directed health plan strategies. Paul has been featured as a speaker at national industry conferences and regularly hosts webcasts to help educate advisors, employers, employees, on the benefits of HSAs. As a reminder, your line will be muted throughout the call, but if you have any questions you would like addressed at the end of the session, please enter them in the webinar control panel, and we will address them at the end of the session. With that, I will turn it over to Paul.
Thank you, Joe. Welcome, everybody. As Joe said, my name is Paul Oakford. I am with Epic Retirement Plan Services, and I head up our health savings account program. I want to thank you all for taking time out of your busy schedules to participate in this webcast. I hope at the end of it, you'll have a little better understanding of what an HSA is, and maybe some ideas start you thinking about how HSAs might fit in to your clients' conversations. In our presentation today, I'm going to talk about really start off with give you a little better understanding of what an HSA is and how they work. And then we're going to go into some things that are going on within the industry to kind of give you a better picture of how HSAs are being adapted around the country. Then we'll talk about the typical HSA solution on the market. And then we'll kind of wrap it up with how our own My HSA Health Savings Account program works. And then we'll have some time for some questions. The first slide here, this is just kind of, I want to paint a picture for you of what Epic does. Some of you may be really familiar with this. Those of you who've worked with us, we've been in the defined contribution record keeping business for a long time, and as you can see, we service thousands and thousands of plans all over the country. We've got hundreds of thousands of participants who we do record keeping for, and over $25 billion in assets. So we've been around for a long time. We're really good at what we do, and we created an HSA solution that kind of fits in the retirement plan structure. So I'm excited to talk to you. So let's move on. What is an HSA? Well, HSAs were created in December of 2003. It's hard to believe that we're coming up on the 20th birthday of HSAs. It seems like it was just yesterday that they were created, but they really have been around for a long time now. And you're going to see some significant growth in those since they first came out. An HSA is an individually owned account. It is not a joint account. Actually, it cannot be a joint account. It is just an individually owned account. It is not an employer-sponsored plan, and it is not meant to be subject to ERISA. So it's real easy from the employer's standpoint to offer HSAs. Another nice thing about HSAs is, unlike the medical FSA or flexible spending account, with an HSA, there is no use it or lose it component. So people, if you have money, account holders who have money in their account at the end of the year, that money stays in there, rolls over to the next year. And the idea is hopefully that over time, they're starting to build up big balances that they take into retirement with them to pay their Medicare premiums and their Medicare out-of-pocket expenses, all tax-free. And then in addition to that, an HSA travels with the employee. So if an employee terminates or they retire, they take that HSA with them to wherever they go. It is their money. The best thing about HSAs is they've got triple tax savings. And I have not seen another tax savings vehicle that is as good as an HSA. But the money goes in tax-free, it grows tax-free, and no matter what the age of the account holder, if they take it out for qualified medical expenses, it'll come out tax-free. So if that account holder is just using the money in their HSA to pay for qualified medical expenses, they will never pay taxes on the money that's in that account. It is just absolutely fantastic that they created these. Let's talk about the eligibility rules. There's really just 4 criteria that someone must meet in order to open and contribute to an HSA. The first is they have to be enrolled in an HSA qualified health insurance plan. Second, they cannot be enrolled in any non-qualified insurances. And a couple examples of what would be a non-qualified insurance. Somebody who is enrolled in a full benefit flexible spending account would be considered to have non-qualifying insurance. Another one would be, say, an employee is covered by their employer's HSA qualified insurance, and they're also covered by their spouse's non-HSA insurance. Well, the fact that they're covered by their spouse's non-HSA would make them ineligible to contribute. Thirdly, the account holder cannot be enrolled in Medicare Part A, any of them. That is disqualifying. And then lastly, the account holder cannot be claimed as a dependent on someone else's tax return. So as long as the individual meets these 4 criteria, they can open and contribute to an HSA account. Let's talk about how much somebody can put into an HSA. Well, first off, the IRS has broken everybody down into 2 groups, and it's all dependent on how you are covered by your HSA qualified health insurance. If that health insurance covers just you, then you are considered to be an individual. If the health insurance covers you plus anyone else, at least one other person, then you have family coverage. So in 2023, someone with an individual coverage could contribute up to $3,850. Someone with family coverage could contribute up to $7,750. And then if the account holder is 55 or older during 2023, they can put in an additional $1,000 catch-up contribution. Now, in 2024, those numbers, the individual jumps up to $4,150 and family jumps up to $8,300. The catch-up contribution is pretty much locked into the legislation, and it's going to stay at $1,000 from here on out. A nice thing about HSAs is the account holder actually has until federal tax day of the current year to make a contribution for the previous year. So they get a little more time to make that if they need to. Another way that someone can contribute to an HSA is the IRS will allow an account holder to do a one-time transfer or a once-in-a-lifetime transfer from a traditional IRA into an HSA. So I wish you could transfer a whole, your whole IRA balance, but there is a limit on what the IRS will allow. And that limit is tied to the maximum amount you're able to contribute for that year. So let's say someone is 55 or older in 2023 and they want to transfer or roll over $8,750 from an IRA into their HSA. They could do that, but they would not be able to contribute anything else, anything additional to their HSA. And that includes employer money and employee money. So the amount you roll over from an IRA reduces the amount that you can put in for that maximum. Rollovers must apply to the current tax year that it's done. So I couldn't roll money over in 2023 for 2022. If I rolled it in 2023, I have to apply it to 2023. And then there's also a testing period. The IRS says if you're going to do an IRA to HSA rollover, you must remain HSA eligible for the next 12 months. Otherwise, you're going to get subject to taxes and penalties on that rollover. There's two ways to contribute to your HSA: pre-tax dollars and post-tax dollars. Now, you're probably thinking, hey, wait a second, at the beginning of this presentation, you said that there's triple tax savings. Money goes in tax-free. Well, it does. But if an employer wants to do pre-tax contributions at the point of payroll deduction, the employer must add their HSA benefit to a cafeteria plan document. Now, there's additional advantages to doing it this way. Not only are the contributions coming out pre-tax from payroll, but the employer and the employee also save an additional 7.65% FICA med-FICA tax. So they're getting it, both the employer and the employer are getting additional tax savings by running it through a cafeteria plan. There's something called a comparability rule, which I will talk about when we do the post-tax, but that doesn't apply when it's added to a cafeteria plan. And it also would allow the employer to do a matching contribution if the employer chooses to do that. But they, like all other benefits under a cafeteria plan umbrella, HSA contributions would be tested for the non-discrimination rules that apply to the cafeteria plan. So there is some testing that goes with that. Post-tax contributions. Well, this is when the money comes out after tax from an employee's payroll, but the employee still or the account holder still gets the tax benefits. They just take an above the line deduction from their gross income when they file their personal income taxes. So they get the savings. They just don't get it at the point of payroll deduction. They get it when they do their personal income taxes, but they do not get that 7.65% FICA med-FICA tax savings. The only way they get that is if contributions are done through a cafeteria plan. Now, the comparability rule. This rule says if an employer is going to make a contribution to their employees' HSA, they have to make comparable contributions to everybody who's in a specific class. So an employer can break their employees into different categories, such as full-time versus part-time. They may say, hey, if you're part-time, we're not going to make a contribution to your HSA account, and that's okay. They can also break it down. The most common that we see is employers say, well, if you're on the health insurance as an individual, on the company-sponsored health insurance as an individual, we're going to contribute X amount of dollars to you. So everybody who is in that classification will get X amount of dollars from the employer. And then they say, well, if you've got 2 or more people on the health insurance, we're going to give you Y amount of dollars into your HSA. And then everybody who is in that category gets the same amount of money. That's what the comparability rule is and how it works. And if you're doing post-tax contributions, the employer must follow that. So distributions from an HSA. So distributions for qualified medical expenses are always going to be tax-free. And not only are distributions for qualified medical expenses for the account holder tax-free, but also for the spouse and any qualified dependents. Their medical expenses are all tax-free. And let's say that the spouse and the dependents are not on the employee's HSA qualified insurance. Maybe they're on somebody else's health insurance that's not even HSA qualified. The employee or the account holder can still use the money in their HSA account to pay for their spouses and dependents' medical expenses, all tax-free. Now, an account holder can always take money out of their account for a non-qualified distribution. I got to go buy a big screen TV at Best Buy, and I want to use my money to pay for that TV. I absolutely can use HSA dollars to do that. But I'm going to pay ordinary income tax on that distribution. And if I am under the age of 65, I'm going to pay an additional 20% tax penalty on that distribution. If I'm over 65, if I'm 65 or older, and I want to take money out for a non-qualified distribution, I still pay ordinary income tax, but that 20% tax penalty goes away. So for non-qualified distributions after the age of 65, they work a lot like a traditional IRA, and that just gives the account holder some more ways to use their HSA in retirement, so it really becomes or should become part of their retirement strategy. And remember, qualified medical expenses are always tax-free. Another thing, distributions from an HSA do not have to occur in the same year that the actual medical expense happened. So we've got account holders that pay for their medical expenses with after-tax dollars or non-HSA dollars, and maybe 5, 10, 15 years from now, they're going to open up their shoebox that they've been saving all those receipts in, and they're going to take a lump sum distribution later on in life, tax-free from their HSA, to reimburse themselves for all of those expenses. And another great thing about HSAs is there's no RMD with an HSA. There's nobody saying, hey, once you hit this age, you have to start taking money out of your HSA. So that's another really nice benefit. Okay, that's a little bit about HSAs and how they work. Now I want to go into some industry level data. And these next few slides that we're going to go over are from a company called Devonair Research. Devonair does a market study of the HSA industry twice a year. They do a mid-year, which they're just completing for 2023, and then they do a year-end analysis. And all of these slides that I'm going to go over are from the 12/31/2022 year-end analysis. But at 12/31/2022, they determined that there is over 35.5 million HSA accounts out there. And you can see from here, they go back to 2011, and the growth that HSAs have incurred since then, pretty significant in the number of accounts that are out there. So there's a lot of people that have these, and it's a great opportunity for advisors to talk with them about it. Devonair also determined that there is over $104 billion held within HSA accounts. Now, that includes both money in the HSA checking account and invested dollars. The total invested dollars in HSA is only $33.8 billion of that $104 billion. I really believe that's low. And when I get into talking about the most common type of HSA program out there, I think it'll help you see why I believe these numbers are low. And I think it's a great opportunity for advisors to get in and talk with employers about, to help educate the employer on really what they have with an HSA. So a few key findings that came out of the report, the Devenir year-end report. Again, at the end of 2022, there were $104 billion in HSA assets held among 35.5 million accounts. That was a year-over-year increase of 6% for assets and 9% for accounts. Again, I just want to show you that HSAs are just getting more popular. There's still growth, a lot of growth to be had within the HSA industry. Contributions to HSAs continue to rise. Account holders contributed $47 billion to their HSA accounts in 2022. That was up 11% from the prior year. Almost for investments, growth in the investment accounts. Almost 2.6 million health savings accounts have at least a portion of their HSA dollars invested. That represents over 7% of all accounts. Again, I think that's low, and I think that creates opportunities for advisors. Devenir, they are making a projection. They say that the market will approach 43 million accounts by the end of 2025, holding almost $150 billion in assets. Again, with the $70 billion sitting in checking accounts earning next to nothing, I think employers don't really necessarily understand the real benefits of the HSA. So they're not really educating their employees on the real benefits. People are looking at an HSA as a checking account solution earning next to nothing. And they're kind of treating them as a short-term spending vehicle as opposed to a long-term savings vehicle. Employers, employees, they all need help, and advisors, you guys talk about investments and retirement. You're the perfect solution to get in and help educate employees on this. And hopefully incorporating HSAs into your conversation with employers will also lead to opportunities for new 401k plans, because most advisors are only talking about 401k plans and not about the HSA. So if you can incorporate that, I think it's going to drive other opportunities for you. Fidelity did a study, and they said that a 65-year-old couple retiring in 2023 is going to need an estimated $315,000 to cover the retiree healthcare costs. An HSA is a great way to start saving today for those expenses that you're going to have in retirement, all tax-free. So that's just some industry level information. Now we're going to I want to talk with you about the typical HSA on the market today. And I would say this makes up about 95% or higher have this basic model as their HSA solution. They all start out with a basic checking account earning low interest rates. The account holder will get a debit card with their HSA. That debit card is only going to have access to the money that is in that checking account. If the HSA offers investments, it's going to be a completely separate brokerage account. The checking account and the brokerage account do not communicate with each other. If the account holder wants to invest, they have to funnel money from the checking account into the brokerage account. If they need money to pay for qualified medical expenses, they have to go into their brokerage account, select which funds to sell off, and then transfer that money into their checking account in order to get access to their invested money on their debit card. So I think this type of setup, because it's multiple, in theory they have one HSA account, but in reality they have two accounts that they are managing within that HSA solution. But it requires the account holder to take multiple steps when they get into investing, which not a lot of people like to do. But I think even more importantly, a lot of people get intimidated by investments. They don't necessarily feel comfortable having to go in and select which funds to sell off. They're always afraid that, well, what if I sell this fund today and it goes way up tomorrow? I've lost out on money. So I think that kind of intimidates people, and they end up saying, well, I'm just going to keep money in that checking account to pay for medical expenses. And then the thought process jumps to, well, why do I want to put thousands and thousands of dollars in this account? Because it's earning very low interest rates. So they end up keeping just what they think they're going to spend on medical expenses in that checking account. And they use it as a short-term spending vehicle as opposed to a long-term savings program. Our My HSA, I like to think, obviously, it's a better solution, but here's why. As I said at the beginning, we created a 401k inspired HSA solution based off of the knowledge we have in administering 401k plans. With our solution, our My HSA, the account holder really only has one HSA account that holds both cash and investments. They have a very low cash threshold in the account. As a matter of fact, the most cash that they can actually contribute to their HSA or hold in their HSA, I should say, is only $200. Once they have deposited more than that cash threshold, their money gets automatically invested. We recognize that our account holders need access to their invested money to pay their qualified medical expenses. But instead of having them go in and transfer money here and there, we give them access to a large amount of their HSA investment options on their debit card, between 95 and 100% of their total account balance on that debit card. So really all they have to do is go to the doctor, or the pharmacy or whoever they're getting medical supplies from, give them their debit card. As long as there's enough money in the account, our system, if needed, will liquidate investments using a pro rata formula to pay that claim out. The account holder doesn't have to do anything. It's seamless to them. So automatic investing and easy access to their invested dollars when needed to pay for qualified medical expenses. Another really neat thing that Epic offers that not many HSA administrators can is, if you're working with us, if we are administering the employer's 401k plan and the HSA, the employees only have to log into one account in order to view both their 401k and their HSA accounts. It's really nice just to have it all packaged right there with one login. Let's talk about the investment options in our My HSA retail program. We've taken an open architecture investment menu, and the type of investments include, we have 5 risk-based asset allocation portfolios. We've got a number of target date funds. We have a large number of individual mutual funds, and it's a mixture of those individual mutual funds that make up the asset allocation portfolio. And then one of the funds in their individual funds, which is also our default fund, is this MetLife guaranteed account. It is an account where MetLife guarantees the principal that you invest with them based off of MetLife's full faith and credit. And they also pay a guaranteed interest rate. Currently, that interest rate is locked in until the end of September 2024. And that rate is 4.92%. So it's a pretty attractive rate that we currently have, and it's locked in for another little over a year. So if we look at the debonair numbers of a number of accounts and assets, and you just do the math, they say the national average balance in an HSA is just a little under $3,000. Our average account balance in our My HSA program is a little over $13,000. Again, I think that's because we're not the checking account solution. Ours really is a 401k inspired with investments, and I think people tend to view us more as a long-term savings vehicle and part of the retirement strategy than they do the basic checking account HSA solution. So let's say you decide, hey, I've got some clients that I want to market this to. We're going to compensate you as a distribution partner to sell our retail My HSA solution. And we are one of the few HSA administrators that still compensate our distribution partners. But there's really no work you have to do. Epic is going to do all of the daily administration of the accounts. We're going to be responsible for the investment menu. We provide a help desk for our account holders to call to ask questions. We have account managers for the employers. And then we also send out the statements and the annual tax forms to the account holders. Really, as a distribution partner, our advisors just introduce us to the employer. We will assist in the sales process, and we'll do everything. And for just introducing us, we're going to pay you 11% of the monthly admin fee, which really comes out to about 50 cents per month per account for as long as we have that employer with us. We do offer what I call an advisor solution, where we can create an HSA solution for an advisor. It's on the same chassis as our retail program, except for the advisor will be responsible for the investment menu. You can create the portfolios, and for doing that, you can charge an asset-based fee to the employers and clients who adopt your HSA solution. Now, it takes a little while to get set up. We want you to have a number of HSA accounts. We're going to give you a little while to get there, but this is for someone who says, hey, I've got a lot of clients that I know are going to get into the HSA. Our retail program, we could have you, we could enroll your clients tomorrow. It's that quick. So here is, I just put in, those of you who use us for record keeping for your 401k plans, you're going to recognize this. This is Go Retire. This is what the HSA portal looks like. Very similar. And really, that's about it, everybody. Anyone have questions?
Well, thank you very much, Paul. We're now going to open the floor up for a few minutes of questions. If you have something that you'd like to run by us, please enter it in the question panel below. We do have one question that has come in thus far, Paul. With the rise in healthcare costs, has there been any conversations about increasing the limits for HSA contributions?
Yeah, great question, Joe. They actually increase year after year. The IRS sets those. It's just like the cost of living for Social Security. There's an automatic trigger. I think I've only seen 1 year since HSAs were created that they didn't increase. but there's no legislation out there for any additional over and above that.
Great, thank you. One other question that has come in, you've worked with advisors that have rolled out the HSA program. Any strategies or tips that you can share in terms of initiating conversations with prospective sponsors or business owners that an advisor can use?
Yeah, absolutely. I think there's a what I call low-hanging fruit out there that advisors can go after. I don't have a slide in here, but Fidelity did a study a few years ago where they talked to a number of their sponsors, and over 55% of those sponsors who replied to the survey said they already offered an HSA qualified health insurance plan. And out of those, 88%, I believe, said that they offer an HSA solution as well. So I would guess how these have been growing, over 55% of your current customers already offer HSAs. So it would be easy to go in and start with those employers to get them to adopt an HSA solution through you.
Great. We do have another question that came in. Are employer contributions eligible for investment by the employee as well as their own employee contributions?
Yeah, absolutely. All of the money that's in the account holder's HSA account is going to be invested. So the only $200, whether that is all employee, all employer, or a combination, will sit in cash. Everything else that comes in afterwards is automatically invested.
One other question that just came in. Can you talk through using the advisory solution, the advisory fee that an investment advisor can charge on one of the HSA programs?
Yeah, it really depends on, I always tell an advisor, how much hands-on do you think you're going to be? Obviously, the more hands-on that an advisor is with educating and walking the employees through the process, the more they can charge. Typically, I think I see from 10 basis points to 50 basis points is probably the most that I see, but you could have somebody do even more than that if they were really hands-on in the process.
All right. Well, thank you, Paul. Looks like that is the last of the questions that has flowed through. So we appreciate you, Paul, for hosting this month's session. And we thank you all for joining us for this Epic Insight webinar. As a reminder, we will be sending out a copy of today's presentation and a recording of the session as a follow-up. And as always, we wish you safety and health as you support your family, colleagues, and clients. Please don't hesitate to contact us if there's anything that Epic Retirement Plan Services can do to support you in your efforts. We thank you, and we look forward to having you join us for an upcoming edition of Epic Insight.